We get more tariffs, but the markets seem to take it, dare we say, in stride. What does that mean? And where are we going from here if this is what's happening? That's what we're going to try to unpick here as we look down the barrel of another bit of macro event risk. U.S. inflation data again in front of us. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are going to unpack what the price action here seems to be saying and what we might see then in the wake of these new announcements and as the data starts to hit markets once again. So let's first consider here what has occurred when we got this announcement of new auto tariffs, and we're less sort of concerned with the substance of the announcement. It's more so the market reaction. And we start here from the S&P 500 just to get a sense for overall risk appetite. And needless to say, we have our bearings here. This was the rally last year going into the election. We can see it held up through the election and then stalled going into the new year, gave us a consolidative period from early December through basically the end or middle to end of February, where we got some disappointing economic data that suggested recession fears are building or have reason to build, and we've had a massive sell-off. And about the beginning of last week, we started to crawl higher. And as we discussed then, that appeared to suggest that maybe what we're looking at is the market saying, okay, we're going to get some untoward policy from the administration. We don't like tariffs, and more importantly, we don't like uncertainty about the tariffs. We don't like uncertainty about government staffing levels. We don't like uncertainty of any kind. It would be much better if there were a longer-term agenda that were delivered that we could benchmark against, value assets accordingly, and move on. But since we're going back and forth here, we don't have that. And we tried to discipline officials with market action. Of course, we can see that here. Get the first round of tariff headlines, there's a lurch. The tariff uncertainty starts to show up in the PMIs and the consumer confidence data. There's a sell-off. But the message from the administration has been, this is fine. This is a necessary adjustment. The economy will not careen into a ditch here. This is the markets kind of onboarding this hard change in policy that we're implementing. This is normal. And the message is coming from credible sources. Certainly, the Treasury Secretary, Scott Bessent, as a macro hedge fund investor that grew up under the tutelage of the great George Soros, who really knows this architecture and these mechanics, possibly better than anyone, or certainly one of the great practitioners of this possibly ever. So when Scott Bessent comes out and says, yeah, okay, you know what, this is fine, the markets take those comments as earnest and say, yeah, they're really not going to react. But of course, the markets want some sort of out because the uncertainty lingers. And so going into last week's Fed announcement, there seems to be this sense that, well, okay, we're not going to get a response to market discipline from the administration. So instead, we're going to need the Fed to come and ease monetary policy and give us the cushion of cheap money to withstand the volatility until the dust settles. And that seems to be the motivation behind this rebound into the Fed and then the rise after the Fed. We get this data on the PMIs this week, and it's almost as if we get some reinforcement, and that helps this pop to extend. Here's the numbers we get. They're not great, certainly not like where growth was last year, but they are encouraging. So the composite showing faster overall economic growth than expected, 53.5 versus 51.5. So the expectation was the growth would remain, but at a slower rate. It came out faster. That occurs because the service sector ends up seeing faster economic activity growth than expected by a significant margin, 54.3 versus near standstill expected. In this PMI logic, 50 is neutral, above 50 is growth, below 50 is contraction. And the faster you go, the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So mild contraction on manufacturing ends up being a little bit worse than expected. But the essence of overall growth, in that it's powered by services, ends up looking better. And so we get this rally that extends. Then, of course, the auto tariffs come. The whispers of them appear during market hours yesterday. They don't get confirmed until after, but there is a sell-off on those grounds. That makes sense. Markets, much as the Fed, are waiting to see what these particular tariffs do. Nobody knows yet, but they do know that historically the tendency is for tariffs to be bad for growth and to be an uplift on inflation. And so while nobody knows what any of the tariffs that have been implemented since the beginning of 2025 will ultimately do, because they haven't really worked their way into the markets and through inventories yet, what we do know is that the history has a precedent, and until we know otherwise, that seems to be what the markets are operating on. So not surprisingly, stocks come down. But notably, they don't break the bounds of this move higher. They hold up. This former cluster here, where the market was stuck after the Fed, then broke cleanly higher, it's been retested, but it hasn't been overturned. And so the series of higher highs and higher lows here remains intact. The market pointedly didn't like the news, but didn't think enough of it to really restart the down move. Fast forward to bonds and you get a similar story. If historically, again, the benchmark is more tariffs are inflationary, it makes sense why interest rates would go up here. This, of course, is the 30-year bond. It's down a bit, meaning interest rates are up a bit, and it doesn't sell off back into this more ominous area. It sort of holds its recent swing highs, much as on a backtest as support, that is. So again, the market doesn't run away with the announcement. It doesn't like it. It follows a familiar sort of playbook for what it thinks tariffs will do, but it doesn't want to have the big move at this point. Same thing for the dollar. Typically, more tariff news has been positive for the dollar. On the risk aversion, of course, dollar is a go-to haven asset because of its unrivaled liquidity in times of risk appetite stress. Also, there is the expectation that if you tariff imports, then demand will shift to the extent possible to domestic firms, and so less money, as it were, is flowing out through the trade channel, and that's somewhat supportive for the U.S. dollar. So when you get a tariff news headline type of a thing, typically the dollar has strengthened, at least in this recent go-around. But not only does it not strengthen, it weakens, and even so against the euro, considering that the auto tariffs hit specifically at countries and regions that export a lot of cars to the US. And of course, Europe is very much on that list. Just list all your German automakers and you can see why. So the markets have a curious response. They don't buy dollars. They don't crash the bonds and run up interest rates in a very dramatic way. And stocks manage to hold up. It is as if there is reinforcement of this idea that if the White House is not going to respond to market discipline, then everything's okay and can be weathered as long as the Fed does, as long as the Fed comes and rescues everybody. And the message from the Fed was, of course, we see what you see, we commiserate with your concerns about this uncertainty. We don't see signs of economic weakness in hard data, though we also see the survey data that you see. So we know the concern. We've sat up in our seat, as it were. We see that there's been a clear level change in U.S. economic growth dynamics, looking at the survey data from here, all of the second half of last year, to here, essentially the lower part of the kind of post-COVID settling range here. So if we see it in the hard data, the Fed says, we will act. Therein is the focus going forward. We can see that in the wake of the Fed, the markets have basically aligned with its policy prognostications. So if we look at what is currently baked in, the markets see 92 basis points in rate cuts between now and the end of next year. They're narrowly expecting more of them to be front-loaded, 60 basis points on the menu for this year. So full 2 cuts and a little bit less than a 50-50 shot at a third one. And next year, 33 basis points, so at least 1 cut with about a 50-50 shot for a second. All in, that's about 100 basis points, 92 specifically, but almost 100. So 3 cuts erring on 4 that are currently baked in. And we can see the markets have been relatively steady in that through the run-up into the Fed and thereafter. And of course, that lines up with what the Fed's expectations have been. As we just said, they too don't know what this particular round of tariffs, those instituted so far in 2025 and still coming, will do, but they do know what the history is. And so in the last adjustment, we get lower GDP growth expectations, higher inflation expectations, but the path of rates remains unchanged, as though the Fed is saying, well, we have to do this for the forecast because all we have is the look back. We don't know exactly, but on policy, we're going to have to wait for the hard data and then we'll see. But as we can see, from 4.4 to 3.9 this year, that's 50 basis points. And then for next year, from 3.9 to 3.4, that's another 50 basis points. So 100 basis points for the Fed, 92 for markets. Take away liquidity considerations and speculative fuzz, and this is basically alignment. So now the key question operating in markets is, will the Fed in fact ride to the rescue? That, of course, then becomes a question of monitoring this quote-unquote hard data. And the first inflection point here, near term, is this. This comes at us over the next 24 hours here. This is the U.S. PCE inflation data. This is the Fed's favored gauge of price growth. And so, needless to say, an important consideration for the markets. And so it will be very interesting to see if, in fact, what we are going to see here is going to be some sort of a reflection of what the markets think the Fed might do. And this is then really where the rubber meets the road for markets. Because one thing that, of course, we know about the PCE numbers is the market is generally pretty good at benchmarking them once we have the data from the CPI and the PCE releases that come, or the PPI rather, releases that come out with the same sort of period but are released earlier. And of course, we've had those releases already. So now markets ostensibly have what they need to construct a pretty significant and accurate forecast of what this data might look like. And this is then, from a speculative kind of perspective, the key question here. Does whatever come out in this release have the ability to really move markets if it's not going to surprise very much? And therein, you sort of get the duality of economic data. On the one hand, of course, it can be significant for its substance. Data comes out, it's a little bit different than expected. Things change. Markets have to reprice for different expectations. And so we can see here the expectation isn't really a dramatic one. 2.7% on the core is a little bit of a wiggle within a familiar range. 2.5% at the headline is unchanged. Doesn't look like we'll get much substance if these forecasts hold. Then, of course, the question becomes, okay, well, if the forecasts hold, if the data is not controversial, might it still be market moving? And the answer is yes, if the markets already have a default in mind and they're just waiting to get to the other side of the event risk. They don't want to front run it because they don't know what the data is going to say, but as long as it says what they think, that will be a way to get event risk in the rear view and have confidence to go do whatever the markets wanted to do. Just now with event risk out of their way. And how that might work here and what the default is, that could be an interesting consideration. So if we look at the Cleveland Fed's forecasting of these numbers, we can see that generally speaking, the numbers for the headline hew very closely to forecast. This is that quality forecasting that we're talking about. For the core, it can veer a little, but as we can see, most recently we're sitting right in line. And so the expectation is we go a little bit lower on the core, we go a little bit lower on the headline. That's a little bit clashing with expectations for the core. That might be some kind of a substantive deviation, but as long as it's not a big one, it need not sort of meaningfully uncouple Fed policy expectations. As we said, the expectation is that you go from 2.6 to 2.7% on the core, and when you look at what's being implied in this view from the Cleveland Fed model, you're looking at a little bit cooler on the core, closer to 2.6, so maybe unchanged rather than higher. And for headline, the forecast is 2.4, not 2.5, so again, a little bit lower. We'll see if that's the kind of surprise we get here and what the markets make of it. If it's a really dramatic surprise, then of course recession risks come back because that implies some sort of a deeper concern about the economy. But if it's a modest surprise, much as we saw with the CPI report, well then the economy is creaking along, but the Fed is more likely to ease. That's good news. This is what we saw from the CPI report where the core was a little bit lighter than expected, 3.1 versus 3.2. The headline was a little bit lighter than expected. And of course, that was the beginning of the markets looking at their anticipation for the Fed and say, okay, we can start to come up off this bottom a little bit because the Fed is going to look at these CPI numbers and help us. If the PCE does something along those same lines, then that becomes a sort of reflection of the default. If we consider the annualized dynamics here, which is what the Fed looks at very closely, we can see that we've basically started to inch a little bit lower on the 3-month annualized rate, but the 6-month is still looking a bit elevated. So from a near-term dynamics perspective, as long as you don't upset the apple cart and you come in a little bit, but not a lot, you start to get the sense that, okay, the markets are going to look at this as benign disinflation, not hair on fire, the economy is falling apart, decline in price impulse. And so that could be something that's sustainable here for risk sentiment. That same CPI report, though, did have a little bit of an interesting nuance, and this might be some of the hard data that the Fed is looking at. If we look at what happened with the CPI data, we can see that it's certainly declined, both at the headline and core, but not because of anything in goods or not because of anything in food, and the contribution from energy was negative, but relatively small. This, however, is very interesting indeed, because it suggests that most of the disinflation we saw came from the same place where most economic growth is coming from, and implying a weakening demand pull impulse on prices. That is to say, if the core services sector is weakening, such that there is less upward pressure on prices in that sector because less demand, so less competition for supply, so weaker increase in prices, well, then that's exactly the hard data that you'd want to see to tell you the economy is beginning to roll over. Why is core services so important? Well, that shouldn't be that much of a surprise. Again, look at what's driving growth here. The composite index that tracks the overall economy is following services. Manufacturing is kind of over here by itself. And that's because the overwhelming majority of U.S. economic growth is generated through services. The overwhelming share of employment is in services. And of course, most inflation then is in services. And so if we get the internals of this report, and it seems like there is a significant reshuffling such that core services looks like it's weakening, and that's where the downside surprise or any downside surprise might come from, well, then the hard data for the Fed may be there. And if it's a really significant adjustment, then we go back to recession fears, and this is bad for risk. But as long as it's tolerable and it beckons the Fed into action without really raising alarm bells about the economy beyond where they already are, and it sort of echoes this, then you start going down the major assets and get the sense that going into the U.S. jobs report next week, the sense might be, oh, the Fed is going to ride to the rescue. And indeed, that might explain why stocks might bounce, having held here, why bonds might bounce and interest rates come in, having held here, and why the dollar, which has already started to weaken, may actually see more of that and at least come into this area on the euro as a more dovish Fed expectation moves through the market. And that is macro money for today. As ever, We are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris tomorrow, as I am every Friday for Futures Power Hour, back with Victor Jones and Tom for First Call on Sundays. That's coming up at Market Open next week. On with Victor for the Price of Truth on Tuesdays. Back with Chris for Futures Power Hour Mondays as well. Writing for the News and Insights portion of tastylive.com. Opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money is back next week.